Hello, good afternoon. Well, in today's class, we will be discussing about foreign exchange. That is our unit 10. Firstly, we will be discussing about the concept of foreign exchange and the factor influencing these rates, and also about exchange rate mechanism. So, first of all, we'll start with the concept, the meaning of foreign exchange. Well, uh, foreign exchange, or it is also known as forex or FX. It basically refers to the global marketplace for buying and selling currencies. It is one of the largest and most liquid financial market in the world, with a daily trading volume exceeding $7 trillion. Foreign exchange involves conversion of one currency into another, and it plays a crucial role in international trade, finance, and investment. Now, we'll look into some definitions of foreign exchange. Well, while defining foreign exchange, it can be broadly defined in two ways. The first one is as a marketplace. Well, it is a decentralized global market where currencies are traded. This includes banks, financial institutions, government, businesses, and individual traders, or as a financial assets. So, foreign exchange also refers to the actual process of exchanging one currency for another, which is necessary for international business travel and also investing. Now, foreign exchange is essential for the global economy, and its significance can be understood through various factors. One such factor is facilitates international trades and investment. Well, businesses and individuals need foreign exchange to conduct transaction across borders. Also, the exporters receive payment in different currencies, which they convert into their home currency. And the importers need to pay in foreign currencies, requiring them to exchange their local currency. Also, we have FDIs, that is foreign direct investments and portfolio investment. They involve currency conversion, affecting capital flow worldwide. Now, the next factor is maintains economic stability. Well, governments and central bank use foreign exchange markets to stabilize their economies by controlling inflation, interest rate, and economic growth. Foreign exchange reserves, basically held by central banks, act as a buffer against financial crises and help maintain exchange rate stability. It now coming to the next factor, it basically support tourism and migration. Well, tourists exchange their home currency for the local currency of the country they visit. Migrant workers send remittance back to their home currencies, requiring foreign exchange transactions. Now, we'll look into some components of foreign exchange market. Well, the forex market operate in different segments, each playing a vital role in currency exchange. The first thing is spot market. Well, currencies are traded for immediate delivery, typically settled within 2 business days. Also, prices are determined by supply and demand factors, including interest rate, economic stability, and geopolitical events. Next component is forward market. Well, agreements are made to exchange a specified amount of currency at a predetermined rate on a future date. Also used by businesses and investors to hedge against currency risk. So that is the concept of forward market. Next component is future markets. Well, standardized contracts are traded on exchange specifying the amount and date for currency delivery. It is popular among traders and institutional investors to speculate on currency movements. Next component is option markets. Well, investors have the high but not the obligation to exchange currency. Uh, Give me a minute, please. Yes. Yeah, the next component is swap markets. Well, two parties exchange currencies for a specified period and then reverse the transaction later. Also, central bank and large corporations use swaps to manage liquidity and also exposure to currency fluctuations. Now, the next thing is we need to understand about the major participants in foreign exchange market. Well, several key players influence foreign trading and exchange rate movements. The first player is central bank and the government. Well, central bank and government basically control monetary policy, manage currency reserves, and intervene in forex market to stabilize exchange rate. Well, the examples are the Federal Reserve, that is US, and European Central Bank, ECB, and Bank of Japan, that is BOJ. Next is commercial banks and financial institutions. So basically, they act as intermediaries which facilitate currency exchange for businesses, investors, and individuals. They also participate in forex trading for profit and risk management. Next participant is corporation and businesses. Basically, multinational companies engage in foreign transactions to pay for import, export, and overseas operations. Next is investors and speculators. Well, hedge funds, retail traders, and institutional investors participate in forex trading to provide from price fluctuations. Also, tourist and individual, basically they are exchange currency for travel, education, or remittance. Then we have exchange rate system. Well, currencies are valued based on exchange rate system, which determine their movement in the forex market. Well, the first thing over here is fixed exchange rate. So the government peg their currency to another currency at a fixed rate, right? Uh, Next is floating exchange rate. So the currency value fluctuate based on market forces such as supply and demand. Then we have pegged exchange rate, PEGGED, pegged exchange rate. So it is a hybrid system where a currency is tied to another but allowed to fluctuate within a control range. Well, for example, some Gulf countries peg their currencies to the US dollar. So that is known as pegged exchange rate. Next is factors influencing foreign exchange rates. Well, several economic, political, and financial factors impact currency exchange rates. The first is interest rate. So the higher interest rate attract foreign capital, increasing demand for the currency. And lower interest rate make a currency less attractive to investors. Next factor is inflation rates. So high inflation erodes our currency value, leading to depreciation. And low inflation strengthens our country's purchasing power. Next factor is economic growth and stability. Well, a strong economic performance attracts foreign investment, boosting currency value. Also, political instability and economic crises lead to depreciation. Next is trade balance and current account. So, a trade surplus is strengthen a currency, and a trade deficit weakens a currency. So, that is the concept of trade balance and current account. Next factor is market sentiment and speculation. That is, traders' perception of future economic trend influence exchange rate, and political events like war, global crisis affect market sentiment. Now, we need to understand about a foreign exchange reserves. So, central bank hold foreign currency reserve to stabilize their currency, pay for international obligations, and manage economic crises. So, major reserve currencies include the US dollars, euro, British pound, and Japanese yen. Also, one another component over here is risk in foreign exchange. So, foreign trading and currency exchange involve risk, including exchange rate risk, that is, fluctuation in currency values impact businesses and investors. Then the next risk is liquidity risk. So, some currency may have lower liquidity, market making large transaction very difficult. Now, the next risk could be political or economic risk. So, government policies, economic instability, and geopolitical events affect forex market. Now, the next and the last component is future of foreign exchange. Well, with globalization and technological advancement, the forex market continues to evolve. Some key trends include digital currencies. Well, cryptocurrencies and central bank digital currencies known as CBDCs are exchanging foreign forex dynamics. Artificial intelligence and automation. Well, AI driven trading and algorithms are becoming prevalent. Regulatory changes. So, government are tightening regulations to ensure transparency and security in forex trading. All in all, it can be said that foreign exchange is a crucial aspect of global economy, impacting international trade, investment, and economic policies. The forex market provide liquidity, facilitate financial transaction, and also enable currency value adjustment. Understanding forex is essential for businesses, investors, and policymakers to navigate the complexities of the global financial effectively. So with this, our introduction of foreign exchange is completed. Now the next, we'll move on to the next unit, that is Unit 11. It is on foreign exchange market. So give me a moment, please. In a minute, I'll just start this unit. Yes. So the next unit is Unit 11, Foreign Exchange Market. Well, the foreign exchange market or FX market or forex market is a global centralized marketplace where currencies are traded. It is world largest financial market with a daily trading volume exceeding 7 dollars. Yeah. Coming to the characteristics of foreign exchange market. So the first characteristic is it is decentralized and a global market. Well, the market has no central exchange. So it operates as an over-the-counter market, market, meaning transaction occur electronically through banks, brokers, and financial institutions. So it is a truly global market involving participants from all over the world, including government, corporations, banks, hedge funds, and retail traders. Next characteristic is high liquidity. So liquidity basically refers to how easily an asset can be bought or sold without significantly impacting its price. So the forex market is the most liquid financial market, meaning large currencies traded can be executed quickly with minimum price fluctuation. Also, major currency pairs such as Euro and USD, GBP USD, and USD JPY have the highest liquidity. Okay. Now, next characteristics is it operates 24 hours a day, 5 days a week. Well, unlike stock market that have fixed trading hours, the forex market operates 24 hours a day from Monday to Friday, following the sun across different time zones. So the market is divided into four major trading sessions. The first one is the Sydney session, that is in Australia, then Tokyo session in Asia, London session Europe, and New York session North America. And the highest trading activity across during session overlaps, especially between London and New York. Okay. Next characteristics, moving on, that is volatility and price fluctuation. So the forex market is highly volatile, meaning currency prices fluctuate frequently due to changes in supply and demand. Factor influencing volatility include economic data, that is GDP, inflation, interest rate, political events like elections, policy changes, market speculations, and natural disasters and global crises. Also, volatility create trading opportunities but also increases risk. Okay. Now, the next characteristic is leverage and market trading. So leverage allows traders to control larger position with a smaller initial investment. And margin trading requires traders to deposit a percentage of the trade value as collateral with the rest borrowed from the broker. Now moving on to the next characteristic, that is currency pairs and exchange rate determination. Well, forex trading involves currency pairs where one currency exchanged for another. Well, currencies are quoted in pairs such as euro or US dollars, where the first currency is the base currency and the second currency is the quote currency. And also, exchange rate fluctuate due to interest rate differences, economic conditions, market sentiments, and political stability. Next one is no fixed trading location. Well, unlike stock exchanges like NYSE, Nasdaq, and London Stock Exchange, the forex market does not have a physical exchange. So all transactions are conducted electronically via interbank networks, brokers, and online trading platforms. So they have no fixed trading location. Next is influenced by macroeconomics and political factors. Well, currency values are affected by economic indicators such as interest rate. That is, higher interest rates attract foreign investment, strengthening the currency. and inflation rate. So high inflation day values a currency while low inflation strengthens its trade balance. So a trade surplus strengthens a currency while a trade deficit weakens it. And political stability and government policies also influence currency movement. Now, the next characteristics of Forex is multiple market participants. Well, the Forex market consists of a diverse group of participants, including central banks and government. So, it influences exchange rates through monetary policy and interventions. Then we have commercial and investment banks. So, it conduct large scale currency transactions and corporations and businesses. So it engages in foreign forex trading to facilitate international trade and retail traders. So individual traders participate through online brokers. Now the next characteristic is minimal transaction cost. So forex trading typically has low transaction cost as brokers charge small spreads difference between buying and selling prices rather than commissions. And some brokers charge fee for overnight trades or inactivity as well. But overall costs are lower than stock trading. Well, it can be said that foreign exchange market is a highly liquid, decentralized, and a 24-hour market that facilitates international trade, investment, and speculations. Its volatility, leverage, and market influences make it a dynamic yet a risky environment. Understanding its characteristics is crucial for businesses, investors, and traders looking to navigate the forex market successfully. Yeah, so that was about foreign exchange markets and their characteristics. Now, the next thing we need to understand and learn is managing foreign exchange reserve. So, first of all, we need to understand the concept well about the reserves. So, the foreign exchange reserves, that is, forex reserves, are assets held by a country's central bank in foreign currencies. So, these reserves include cash, government securities, gold, and other financial assets. They basically serve as a buffer against economic shocks, help stabilize the national currency, and ensure the country can meet its international obligations. Well, foreign exchange reserves are the external assets that a central bank holds to support its currency value, manage trade imbalances, and intervene in the foreign exchange market when necessary. So these reserves typically consist of foreign currencies, also government bonds and treasury bills, then gold reserves and special draw rights. Then we have IMF reserve position, that is quota in the IMF that a country can access in case of need. Now, what is the purpose and importance of foreign exchange reserve? Well, the very first thing is currency stability and exchange rate management. So, central bank use a forex reserve to stabilize the exchange rate and prevent excessive currency volatility. So, if the local currency depreciates too much, the central bank can sell foreign reserve to support its value. And if the currency appreciates too much, the central bank can buy foreign assets to maintain what? Competitiveness. Okay. Now the next thing is it import cover and trade balance management. So countries rely on foreign reserves to pay for essential imports like oil, machinery, and food. Also, a high level of reserves ensure that a current country can continue importing even during a financial crisis. Then, crisis management and economic stability is there. So, reserves act as a financial safety net during economic turndowns, external debt crisis, or capital flight. During crises, country can use forex reserve to prevent a balance of payment crisis. Next is meeting international debt obligation. So countries with high external debt need forex reserve to repay loans and interest payment in foreign currencies. It also reserve help maintain creditworthiness and attract foreign investment. Also, the reserve helps in boosting investor confidence. So, a country with large forex reserve is perceived as financially stable and encouraging foreign investment. And on the other hand, low reserve can signal financial distress and discourage investors. Now, managing inflation and interest rate. So, a central bank can buy or sell foreign currency to control money supply and inflation. Also, more reserve give policymaker flexibility in adjusting monetary policy. So that was about the characteristics of these reserves. Now, the next thing is we will study is about composition of foreign exchange reserve. So give me a minute. We'll start this topic in a moment. Yeah, yeah. So we were at composition of foreign exchange reserve. So basically, a foreign exchange reserve usually include foreign currencies. So held in major reserve currencies like USD, Euros, JBP, JPY, and CNY. Then next component is foreign government securities. So US Treasury bonds and other government issued financial assets comes under foreign government security. Next is gold reserves. So it is stored in central bank as a hedge against currency risk. Then we have SDR, that is special drawing rights. So it is issued by the IMF to supplement reserves. Also, IMF reserve position. So a country's quota at the IMF, which can be accessed in emergencies. So that is the composition of foreign exchange reserves. Now, let's look into major reserve currencies in the world. So, most foreign exchange reserves are held in a few globalized, recognized, stable currencies. So, the first currency is US dollar, which is denoted as USD, and approximate share in global reserve is around 59%. Next currency is euro, that is EUR, denoted by EUR, and the share is around approximate 20%. Then we have Japanese yen, denoted by JPY, and the share is around approximate 5%. Next currency is British pound, which is denoted as GBP, and the share is around approximate 5%. And next is Chinese yuan, which is denoted as CNY, and the share is around 3%. Whereas other currencies have a share of around 8%. Also, the US dollar dominates global forex reserve because it is widely used for trade, investment, and as a global reserve currency. And the euro is the second largest reserve currency, followed by the Japanese yen JPY and British pound GBP. Now we will discuss about the factors which affect a foreign exchange reserves. Well, trade balance and current account. So countries with a trade surplus, that is more export than import, accumulate foreign forex reserve, whereas countries with a trade deficit use reserve to pay for import and settle trade imbalances. Now, the next thing over here, we will discuss about the challenges and risk managing uh, these reserves. So, the very first challenge is risk of currency depreciation. So, holding reserve in foreign currencies means their value may decline if exchange rate fluctuate. And also low returns on reserve assets. So, most foreign reserves are held in low yield assets like government bonds providing limited returns. Then we have political and economic risk. So, reserves held in global banks, foreign banks, or securities are subject to sanctions, asset freezes, or financial instability. Let's say, for example, Russia's forex reserve were partially frozen due to sanctions in 2022. That is the economic risk, right? Now, the next is cost of holding excess reserve. So, maintaining high forex reserve require monetary policy adjustment that may affect economic growth. Also, excessive reserve could have been invested in domestic infrastructure and also in development. Now, from this unit, an important portion is about foreign exchange reserve management in India. Well, foreign exchange reserve are crucial for Indian economic stability and also for financial security. It is managed by RBI, that is Reserve Bank of India. So these reserves help maintain currency stability, manage inflation, and support economic policies. So India's forex reserve consists of foreign currency assets, gold, SDR, that is a special drawing rights, and the International Monetary Fund reserve positions. Now, let's discuss about the role of Reserve Bank of India in the foreign reserve management. So the RBI is responsible for managing India's foreign reserve, forex reserve and ensuring financial stability through the following measures. That is exchange rate management. So the RBI intervened in the forex market to control excessive fluctuation in the Indian rupee. And if the INR depreciates too much, the RBI sells USD from the reserve to stabilize the currency. So if the INR appreciates too much, then the RBI buy USD to maintain competitiveness. Now, import and debt management. So India uses its forex reserve to pay for crucial imports like crude oil, electronics, and machinery. So the reserve helps India repay external debts and interest payments without financial strain. Now the next management is crisis and liquidity management. So Forex Reserve act as a buffer against economic shocks like capital outflows, trade deficits, or global recessions. So during COVID pandemic, Forex Reserve helped maintain financial stability despite economic disruptions. So this is how they have managed. Next is investment and diversification. So RBI invests Forex Reserve in safe and liquid assets like US Treasury bonds, European government securities, and global financial institutions. Also, a portion held in gold reserves to hedge against currency risk. Uh, Online talking about India's forex reserve trends and current status. Well, in 1991, India faced a severe balance of payment crisis, where reserve barely covering 2 weeks of imports. So, after economic reform and liberalizations, forex reserve increased, crossing $600 billion in 2021. And as of recent data, India ranked among the top 5 countries in terms of forex reserve behind China, Japan, and Switzerland. That was about how India manages foreign exchange reserves. Well, India's foreign exchange reserve management play a critical role in economic stability, crisis management, and currency stability. Also, with growing reserves, strong investment policies, and also diversification, India is well prepared to handle global financial uncertainties. But, however, effective reserve utilization and balanced monetary policies are essential for long term economic growth. So, that was about foreign exchange and foreign exchange management in India. Well, now we'll start our unit 13, that is financial derivatives market. Well, the financial derivative market is a marketplace for financial instrument known as derivatives. So, which derives their value from an underlying assets, index, or a rate. Also, derivatives are used for hedging risk, speculations, and arbitrage. Now we'll look up for types of financial derivatives. The first type is future contracts. So agreements to buy or sell an assets at a predetermined price on a future date is termed as future contracts. Next derivative is Option contracts. So option contract gives the holder the right, but not obligation, mind it, to buy or sell an asset at a specified price before a set expiration date. Next is swaps. So contract to exchange rate flows such as interest rate swaps or currency swaps. Then we have forwards. So customized agreements between two parties to buy and sell an asset at a specified price on a future date is termed as forward. So these are the four types of financial derivatives. I'll repeat again. That is future contracts, option contracts, swaps, and forwards. Now, let's look into the key participants in market. So the first one is hedger. So that is the companies protecting against price fluctuations. Second is speculators. That is traders aiming for profit. Next is market makers. So that is providing liquidity to the market. So that is the basic of financial derivatives market. Now, 1 minute. Let's discuss uses of derivatives. Well, derivatives serves several important functions in financial market. Let's look into a few functions. The first one is hedging risk. So protect against price fluctuation in commodities, currencies, interest rate, and stock. Well, let's take an example to understand this. Like an airline company buys fuel futures to lock in fuel prices and avoid price volatility. Next is speculations. Well, investors and traders use derivatives to bet on the future price movement of an asset. An example is traders buy stock options expecting the stock prices to rise and profit from the price range. Next is arbitrage opportunities. Well, traders exploit price differences between market to make a risk-free profit. Like say, if gold is cheaper in one market and more expensive in another, so a trader can buy low and sell high simultaneously. So that is arbitrage opportunities. Next is portfolio diversification and management. Well, investors use derivatives to gain exposure to different assets classes without directly purchasing them. One fine example could be using index futures to mimic the performance of a stock market index. Also, we have enhancing leverage. So, derivatives allow investors to control a large portion with a relatively small investment. An example could be buying options requires less capital than purchasing the underlying assets outright, increasing potential gains. Next is managing interest rate and currency risk. So companies use interest rate swaps to stabilize loan payment, and exporter and importers use currency derivatives to hedge against exchange rate fluctuation. An example could be a multinational company uses forex forward contract to lock in an exchange rate for future transactions. Now, the last use over here is price discovery. So the prices of futures and option reflect a market expectations and provide insight into future price trends. Like oil futures prices indicate expectations of future crude oil supply and demand. Okay, so that's the uses of derivatives. Now, one important topic over here I can see from examination point of view is functions of financial derivatives market. Let's quickly discuss about that. Give me a minute. Yeah. So we were about to discuss about the functions of financial derivatives market. So the very first function over here is market efficiency. Well, a derivative market enhance overall market efficiency by facilitating the allocation of risk to those most willing to bear it. So this process lead to more efficient capital allocation and support economic growth. Then access to otherwise inaccessible markets. So derivatives provide exposure to assets or markets that may be difficult to access directly. So for instance, weather derivatives allow companies to hedge against adverse weather conditions without needing to invest directly in meteorological assets. Next function is leverage. So derivatives allow participants to control large positions with a relatively small amount of capital. So this leverage can amplify potential gains, but it also increases the risk of significant losses. Let's say options and future contracts enable traders to gain substantial exposure to asset price movement with a limited initial investment. So these are the few functions of financial derivatives market. Also, they play a very important role in global economy by offering instruments that derive their value from underlying assets such as commodities, currencies, interest rate, or stocks. Well, derivatives enable individual and institutions to mitigate potential losses from adverse price movement in underlying assets. By entering into derivative contracts, party can lock in prices or rates, hereby reducing uncertainty. Let's say, take an example, like a company expecting to receive payment in a foreign currency might use currency derivatives to hedge against exchange rate fluctuation. Okay. Also, the trading of derivatives contribute to the discovery of future prices of assets. The prices of derivative contract reflect the collective expectation of market participants regarding future movements of the underlying assets, providing valuable information for businesses and investors. Well, a derivatives market present opportunities for arbitrage as well. So where traders can profit from price discrepancies of the same assets across different markets or derivative forms. Such activities help in aligning prices and maintaining market equilibrium. So, all in all, when we talk about financial market derivatives and the functions of financial market derivatives, though this market is integral to modern financial systems, offering tools for risk management, price discovery, market efficiency, and access to various assets and markets. However, it's essential for participants to understand the inherent risk, especially when engaging in speculative activities or utilizing leverages. So that was about financial derivatives market. I hope I'm clear. Now, next, what is remaining? Let's check. Yeah, we have two units remaining. The first is financial derivative market in India. So under this, we will be discussing about evolution, derivative exchange, category, trading, structure, growth, and also commodity derivative market. So we will be studying about the meaning, commodity exchanges, types of commodities, forward contracts, advantages, and structure of commodity future markets in India. Okay, so these two units are remaining. Probably tomorrow we are having the last class. So in last class, we will discuss about these two units and finish up the class. So meanwhile, if there is any doubt, any query regarding all the 15 units of this paper, you can send me. I'll post my email ID in the chat box over here. So not only now, but for your from your examination point of view also, if you need any help regarding any extra notes or anything, you can send me an email on my email address and I'll be very happy to help you out with those. So for today's class, that was all. There is still time remaining, few minutes are there. I'm here. If you are want to ask, so put your question in the chat box or unmute or ask. Thank you.